How you doing, Martin Lopez for the Real Estate Show? Thank you for coming and hanging out with us again. Today, we're going to talk about understanding your options when it comes to foreclosure. It's huge. A lot of people are very, very concerned about foreclosure and, REO, which is real estate owned, which means homes are getting foreclosed on and all that. So homes right now are not getting foreclosed on. There's not a whole lot of homes that are being foreclosed on, but I want to share with you and talk to you a little bit about what I'm reading, what's happening in the market. So, the truth is that at least the way I see it is, even though experts agree that there's not a chance of a big, large foreclosure crisis like we had back in the 2008, 2012, all that during that, there's a lot of homeowners out there that are facing the possibility of foreclosure. There are people that are facing that possibility, and while overall home prices, the percentage of homeowners that risk is declining and is decreasing with time, that doesn't bring a whole lot of comfort to people when they are, when they're scared, when they're really, really concerned. So I'm going to share with you something like it's a chart. So let me show you this chart. And if you look at this chart, what you're going to see here is the percentage of mortgages in forbearance. And you're going to see that it's actually decreasing. So this thing starts in May of 2020, and today is now September of 2021. So since 2020, when really the forbearance process really started, March, April, May, around that time, what it's saying is that 8.47% of homes was a decrease, then 8.39, then all the way to right now, which is a decrease of 3.26. So what is forbearance? So what forbearance was, it was an option that forbearance was an option that real estate mortgage companies were giving through a government program. They were giving the option to not have to make your payments. So you didn't have to make your monthly payments, but what happened is you eventually have to pay the interest on those payments. So it's really, really a kind of a crazy thing. So if you're in forbearance, and if you've gotten out of forbearance, you've gotten a contract. Well, let me back up. So what forbearance was, you didn't have to make your monthly payments. However, the loan that you owed on, you still owe the interest for that loan. So I'm going to kind of break it down, make it small numbers. Let's say you had $100,000 loan, and every month your house payment, let's say, was $1,500, and then your interest portion of that was $1,000. So you don't pay the $1,500, but you're going to owe the $1,000 every month. So month one, $1,000, month two, another $1,000, month three, another $1,000, month four, another $1,000. So your balance stayed the same, but you now owe the interest portion. Okay. So let's say you owed $100,000 in 4 months, you're not going to owe $104,000. That's how the math works. Okay. The other part of the forbearance people weren't thinking about was their taxes and their insurance had to get paid. So the mortgage companies were then paying your taxes, your insurance, because if you were impounded, meaning your house payment included principal interest, which is your principal pay down, your interest, which is that $1,000 we just talked about, right? And then your taxes, your insurance, and your mortgage insurance. If that stuff wasn't getting paid, you still have to pay that. Now, the mortgage companies often were paying that for you. So when you get out of forbearance, let's say you were in forbearance for 5 or 6 months, let's say in this example, you'd have $5,000 of interest owed, but also the taxes and the insurance for all that would be owed. So what's happening is when people are coming out of forbearance, you're getting contracts from the mortgage companies that say, hey, you owe us that $100,000 plus this other $6,000 or $7,000. And we're going to tack that to the end of your loan. We're going to have 2 loans. You're going to continue paying on the $100,000 loan. This is where you're at. But when you're done paying that loan, guess what? We're expecting you to pay this other amount. And there's interest on that amount too. So in a sense, what you have is you started with 1 loan and now you have 2 loans. So now you have 2 loans that you're going to owe money on, where before you had 1 loan. So you owe the loan that you originally agreed to, and now the unpaid portion that you were in that you didn't pay when you were in forbearance. Okay. So if you haven't taken advantage of forbearance process, it might be time to research and understand your options if you're concerned. So let's get back to foreclosure and what is foreclosure. So I looked up a definition, and Investopedia defines foreclosure as foreclosure is a legal process by which a lender attempts to recover the amount owed on a defaulted loan by taking ownership and selling the mortgaged property. Let's break that down here. What does that mean? Your house, the foreclosure is a legal process, right? And a lender, the mortgage company, is going to recover their mortgage. So in that case, earlier I was talking about the $100,000 plus the other $5,000 or $6,000, $7,000. So they're going to foreclose because they want their money back, right? And they say you defaulted on your loan, which means you didn't make your loan payments. And you didn't make them for a certain period of time. Now, because of that, we're going to take the house back. We're going to foreclose on the house, take the house, and then we're going to keep the money. So there's all kinds of different things you can do. So typically what happens is a default, which is not paying your loan, is triggered by missing a certain number of house payments, right? But the good news is there's alternatives. That's the bad news. But the good news is there's alternatives to foreclosure, and alternatives to losing your house. So you don't want to go through the foreclosure process. So what are different things you can do? There's a thing called reinstatement, which means that you pay back the missing payments, and then the bank says, "Okay, great, you've paid us back. You're up to date, or you're not 3 months or 4 months, whatever, behind. We're okay. We're gonna go ahead and reinstate your loan. We're gonna allow you. We're gonna stop the foreclosure process, and we're gonna reinstate your loan. It's no longer in foreclosure. Please continue to make the payments." That's one option. Another option is something called loan modification. So loan modification is where you contact the bank and you say, hey guys, I didn't make the payments. I lost my job. I couldn't do this. I couldn't do that. What I'd like you to do is I'd like for you to modify the loan. So this is my payment. This is a hard payment for you to make. I'd like for you to now make this payment. Loan modification is something I did, I think, back in 2010 when the market was really, really tough and we were having a tough time just surviving, just staying alive. So what we did is we went and got our loan modified. Okay. So, and then our payment dropped. It did drop quite a bit. So, I think we saved like $500 or $400 on it. That helped out a lot. Right. Then the other thing is something called a deed in lieu of foreclosure. A deed in lieu of foreclosure is when what you do is you give back the property. So you deed the property back to the bank. Now, and then the bank then accepts your property so they don't have to go through the foreclosure process, right? And then the fourth alternative, and there's more alternatives, but I'm just going to talk about four, is something called a short sale, where you're going to sell your house for less than the balance. Okay. So let's say that $106,000 was what you owed, but now your house is only worth $95,000. Well, the bank is saying, hey, you owe us $106,000. So what we're going to do is we're going to short sale. We're going to sell the house. We're going to sell the house for less than the amount that we owe, and the bank then agrees to that. Okay. So those are some options you can take. But before you go down any of those paths, it's really, it's like more than ever, it's worth checking out if you have enough equity in your house so that you can save your house by refinancing. You could rent it out. You could sell it. There's all kinds of options, and you want to know. And the reason there's options is because home prices have been going up crazy, right? They've been crazy. So rather than losing your house, walking away, protect your investment. Protect your investment. And understand what your options are. If you have to refinance, if you have to sell, if you have to do a deed in lieu, whatever, you got to understand what those options are. And I'll tell you something that I've been in this business since 1985, and I've talked to hundreds of people. I mean, during the credit crunch, I was getting 4 or 5 calls a day with people that were like, "What do I do? What do I do?" My friend told me to call you. So there's always alternatives. There's always something, and you got to talk. What you want to do is you want to have a conversation with somebody to see if if there's something you can do. If there's an alternative for you. That's huge, right? You want to see what it is you can do. So in today's market, a lot of people have more equity than they realize in their homes, because over the last couple of years, I mean, home prices have been going up because of demand, supply and demand, and because of low interest rates. So there's, it's likely that if you bought a house a couple of years ago, that you have equity. So let's look at the equity gain. Let's just look real quick at the equity gain that we've had. feedback on. Hey, I'm back. So don't do it alone. Lean on experts for advice. Talk to real estate agents, talk to loan officers, talk to people. Now, this is the thing. When you go out and talk to somebody across the street, and I get that all the time. I'll talk to somebody, and like the other day, I had somebody that I'm doing a refinance for, and he said, "Hey, I talked to my friend at work, and he said I'm getting this rate." And I'm like, "Okay, well, have your friend show you the paperwork that says that." And his friend's like, "I don't want to show you that paperwork." Finally, his friend showed him the paperwork, and it was like not the loan he said he was getting. So the reason I'm saying that is because people are always willing to give advice. It's now there's no shortage of people with opinions, and they're willing to give advice. But there are people out there, real estate professionals, loan officers like myself, mortgage professionals, that understand the market day in and day out. We are working with people, with homeowners, to help them, buy homes, refinance, sell homes, all those different things that we do. So please lean on us. If you're facing a hardship, let's connect. Let's explore your options. The bottom line is, if you have to sell to avoid foreclosure, that's one thing. But if you don't have to sell, if what you can do is stay in your house, keep your house, and maybe refinance and do something, let's talk. Let's figure that out for you. So my name is Martin Lopez. Thanks for hanging out. The Real Estate Show. That's my show every Thursday. If you have any questions, please leave them in the comments below, and I'll be happy to reach out and answer those questions. Thank you. God bless. Have a great weekend. Cheers.